If you're tuning in here, you want the truth, not the sugar-coated garbage you get somewhere else. Just the hard, cold truth. It's difficult to take sometimes, it's not fun, but it certainly gives you more insight as to what's actually happening. Is it possible that the situation in China could topple the entire bull market, the global economy, and spiral downward further and further? Or is it simply that central banks just need to print a whole bunch of money and everything will be fine? You came here for the truth, so let me unveil that for you. Today we're going to look at what's happening inside of China, and then I'm going to show you some statistics that are absolutely out of this world. I have way too many charts, but then again, what else is new? This is going to start with the information regarding China. If you haven't seen yesterday's video, I'm going to link to it at the end of this one. You need to watch that video. It is extremely important. This covers some different information related to that, and I wanted to expand on so many of the stats that I've been showing you all along. A lot to get into. I wanted to begin by taking a look at this. This article here is talking about the banking system in China, and it is seriously taking a hit. Banks are already suffering record loan defaults as the economy last year expanded at the slowest pace in 3 decades. The slump tore through the nation's $41 trillion banking system, forcing the first bank seizure in 2 decades and bailouts of 2 other key lenders. The banking industry is taking a big hit. Certainly the situation that's going on right now is going to have an impact on the local economy, and that has a dramatic impact on what happens outside of the world. If you haven't watched yesterday's video, I talk about that in that one, as well as so many others that I've done. You could see how these countries are intertwined with their financial system, with their imports and exports. The way that business is done today is in a globalized manner, and that is something that sure could change over years, but ultimately at this point, when you got a problem one place, it becomes a problem in another. More than 13% of China's banks were rated as high risk by the central bank, and that just shows you that there are quite a few. This is the government's own numbers, so just imagine what it actually looks like. Defaults and bankruptcies are increasingly common. If you can't see it for yourself, it is absolutely skyrocketing over the years. The latest numbers being 2018 on this for the number of bankruptcy cases. They'll tell you that everything is just fine, but ultimately we see growth there in areas that are not good to have growth in. This is from the Global Times. China should get ready for belt tightening. And you could see at the very bottom of this particular article, the finance minister specifically stated China would not stimulate the economy by rolling out another massive monetary stimulus. This is extremely surprising to me. And despite the fact that this came from the finance minister himself, I simply don't believe it. But of course, I will bring you those details as they come out. China will face decreased fiscal revenues and increased expenditures for some time to come, and the fiscal operation will maintain a state of tight balance. He said that capital must be used in a more effective, precise, and targeted way. I'm not sure exactly what they mean because typically all they do is print a whole bunch of money and lower interest rates. In this article here, they expand on some of the points that he made, and essentially they want to do targeted and phased measures in cutting taxes and expenses to help companies. We'll see if they actually pull through with this and how significant they are, because their usual plan of printing money, lowering interest rates doesn't seem to be working. Now, this is an absolutely jam-packed article that had tons of charts on top of that. They had the point forms at the beginning. I'll have the source in the description as always. Let's cover a few points. The main international benchmark, excluding the US, has essentially flatlined for 14 years, while the S&P has continued to set new records since 2009. Doesn't that seem unusual to you? That if you exclude the United States from the MSCI World Index, things look a lot different. I'll show you it. China, which has been one of the most important developing countries over the last 30 years, outpaced the United States in terms of economic growth. However, the stock market has continued to lag. Emerging markets, same situation. In the US, senior management teams haven't accelerated capital expenditures, something that we've talked about at length here. Instead, what they do, you know it, stock buybacks. In 2018, they're quoting here $1.25 trillion worth of dividends and buybacks, depends on the numbers you use. Ultimately, it's a massive record high. People ask me all the time, what's the problem with this? There's no reason why this is an issue. Well, actually, they get into that. The dark side of this is that net debt to cash flow is at a 16-year high as dividends and buybacks have been running above excess cash flow since 2013. To elevate debt to dangerous levels to enable share repurchases is the antithesis of judicious corporate stewardship. Of course, they don't care about that. One of the most alarming aspects of this buyback bonanza is that companies are repurchasing shares at fever pitch while insiders are dumping their shares at an equally feverish rate. That should be concerning to most people, but as I've said many times before, they really don't care because their portfolio is rising. Take a look at the S&P 500, that's the green line, and the MSCI World Index excluding the US. Doesn't it look very unusual to you to see this? You look at it back in 07, 06, somewhere in this range, and compare that till today, it's the same level. That's not good. Something is definitely not right. And even if you exclude this huge run up and huge fall down to the ground, you can still say that there have been instances that were nearly a decade ago where the prices haven't been able to move up from. On the other hand, we see US stocks simply going into newfound territory year after year after year. 2018 was seemingly an anomaly. Nobody really knows why that happened unless they were paying attention. Share of buybacks in the US versus the Eurozone. This is unbelievable. Take a look at this. You could see the blue line, that's the US, compared to the Eurozone, those are the red lines. It's not even close. Back in the year 2000, on the left-hand side of this chart here, it is very, very accurate to each other. But suddenly, towards the financial crisis, things really took off. And now today, it's not comparable whatsoever. These companies know exactly what they're doing. They're pumping up the stock prices, and the insiders are benefiting to a great degree. The Shanghai Composite, you could see what happened leading into 2015. It spiked up dramatically and has yet to get back to where it was. On the other hand, S&P 500 rocketing higher. This was actually normalized just to compare the two indexes side by side. Same situation with the emerging markets. They've basically been flat for a decade. Record number of companies with positive buybacks. You can see this continues to accelerate. This chart goes back into the 80s up until present day. While it's fluctuating, clearly you can see what's going on. Companies are favoring this method, and you have to ask yourself why you think that's the case. The size of the corporate debt, one rung above junk, has never been greater. This is where all the growth is coming from. We've heard all of the big names now talking about this. Of course, nobody's going to be concerned about it until it's too late. Nobody's going to actually bring this up and suggest, maybe we've got a real problem that we need to deal with. No, it's just going to expand and expand and expand. And during the next financial crisis, whatever causes that, you're going to look at the BBB rated bonds and realize we should have been paying attention. S&P 500 price to sales ratio has hit a record high, never seen this before, not even during the dot-com boom and bust. Insider selling on pace for a 2-decade high. Value of shares sold by company insiders has only been exceeded one time in history. Unbelievable, but we keep hearing about how there is no euphoria today. If all of the numbers were exceeded what we've seen previously, except for just a small handful, how is this not euphoria? Gap between the S&P 500 gap, that is generally accepted accounting principles, and non-GAAP earnings under upward pressure. Just see the direction that this is going. Chart goes back from the late 80s, and while there are variances, it's obvious. It's getting worse and worse and worse. Companies don't report real earnings. Companies like to shuffle things around. They like to hide what they don't want others to see. And why? Because they've got serious fundamental problems that they hope to resolve or at least never have to show the public, but the rot can't be hidden. We always hear earnings per share growth. It's fantastic. It's so wonderful. But Facebook, Amazon, Apple, Microsoft, and Google supported the S&P 500 earnings per share growth. There's a very small handful of companies today that are outperforming everything else, and no matter what happens to these corporations, the stocks keep rising. That's very dangerous, and of course, we need to pay close attention. This chart and the next, I've shown you it before. Just wanted to show you more information. This happens to be regarding options. This one also just giving you an idea of what's happening, which companies are involved, where the speculation is today. As far as I'm concerned, this is unbelievable. They've gone too far. What we've seen in China right now today is very real, at least when we're looking at it from the economic standpoint. The manufacturing base is so important, and yet that's really taking an extended break at this point. Doesn't seem to be over anytime soon. So clearly we have issues to be paying attention to. That's all for this video. If you found it informative, hit the thumbs up button. I really do appreciate that. It helps this channel out. If you want to learn about e-commerce, about how to sell products online, you need to watch this free e-course that I created for my subscribers. Won't cost you a dime, the AmazonGPS.com. If you want the financial education that was not taught to you in the school system on purpose, these two books have everything that you need, top to bottom, A to Z, talking about reducing your debt, tax incentives, the history, the asset classes. These two fit into each other like a lock and key, so definitely check both of them out at the link in the description if you want the audiobook, themoneygps.com. The video I was referring to about China is so jam-packed, it actually performed much better than my other videos. I know a lot of people are interested in this right now. If you haven't seen it, absolutely don't go anywhere else. Click this and I'll see you there.